What is Inflation Induced Debt Destruction? IIDD. It's a real estate concept coined by investor Jason Hartman. According to Hartman and many other investors, inflation-induced debt destruction is what makes real estate attractive. Let's explain this concept through an example. Let's say you're buying a rental property for $400,000. Like most people, you get a mortgage and put down 20% down. That leaves you with borrowing the rest, $320,000 with a 30-year fixed mortgage. With today's rate of 5.8%, you're paying $1,896 per month, excluding taxes and fees. At the end of those 30 years, your total payment will be $682,000 on a $320,000 loan. But then we introduce IIDD into real estate. Inflation is what makes money today less valuable in the future. $1 today will be worth a lot more than what $1 will be in 30 years. Historically, inflation goes up by about 2.5% each year. If we include inflation, that $320,000 we borrowed today would hold the same value as $675,000 in 30 years. Every month, you're paying $1,896 for the next 30 years. Well, your tenant is paying that. Your first payment today is $1,896, and your very last payment 30 years from now will also be $1,896. That payment never changes unless you refinance or get an adjustable rate mortgage. But $1,896 today isn't the same as paying $1,896 in 30 years. In 30 years, paying $1,896 would be the same as paying only $897 today. Inflation-induced debt destruction. Inflation is destroying your debt and making your monthly payments for your mortgage less and less each year. It's beautiful because your rents will go up over time. Maybe next year you raise the rent by $50 and again and again. But because your monthly mortgage stays the same, inflation is destroying the value of that loan, benefiting you in the long term. In 30 years, inflation would have cut your monthly payment by 52.7%. You'll be paying half what you are today in terms of buying power. Let's say your rent starts at $1,900 just to break even with your mortgage, and you decide to increase rent by $50 every year just to keep up with inflation. Your rent in 30 years will be $3,400 per month while you're only paying $1,896 in mortgage. But remember, because of inflation, that $1,896 is only $897 per month in today's value. Rent goes up in value while your mortgage goes down in value thanks to inflation. Everybody is fighting against inflation, and fixed payments like a 30-year fixed mortgage will lose to inflation because of that fixed cost. Real estate appreciates in value at about the same rate as inflation. That $400,000 real estate property you bought today will be worth at least $844,000 in 30 years because of inflation. Your rent will also go up to either match or beat inflation. But your debt is going down because it cannot beat the inflation that's wiping away its value. That's what inflation-induced debt destruction is all about. Let inflation help you pay off your debt. Real estate is such a powerful tool, especially if you're using a fixed debt instrument, a mortgage, to pay for it. So what are your thoughts? Are you starting to get into real estate? Comment below. And as always, take care of your money.